video podcast that keeps you in the mix of everything real estate. I'm Noelle Frieson with the Center for Real Estate Education, and of course we have our power panel. So we have Adam Sperber, who is a resident real estate expert, residential. We have Omar Sharif, who is our flipping and investing guru, also the VP of Alexander Anderson Capital Group. We have my personal guru, Eric Anderson, who is the CEO of Alexander Anderson Real Estate Group. And we have a special guest. Yay! My money guru.
And favorite.
My money guru, Chris Stern, who is with Edward Jones. So we're going to hop right into this.
What is Edward Jones?
It's a financial
brokerage, yeah, financial planning, certified financial planner with Edward Jones.
What does Edward Jones represent?
Money.
What else?
Investments, stocks, comprehensive wealth management.
So today we're going to be talking about whether you should invest in real estate or should you invest in stocks. You want to retire rich. That's the name of the game, retire rich. Which of these two things is going to help you to retire rich?
So basically stocks versus real estate. That's the topic for today. So since Chris is our guest, why don't you start with why stocks are better than real estate?
100% easy. First of all, I didn't know this was going to be a 4-on-1, 5-on-1.
It's actually like one.
Which is good. So
oh my God, I forgot. We have Nima from Miami. Say hi, Nima.
Over there.
Hey, what's up? I don't think anybody can see me though.
They can.
Oh, okay. Well, hey, how are you guys? Nima over here from Miami because I chose real estate instead of stocks. So I can come hang out in Miami with our residual income.
So Nima's joining us from Miami because he chose real estate instead of stocks. Chris, I think you're going to be outnumbered today, but
that's all right. I can handle it. So let's just jump in. Oh, is Nima, you done?
No, he's done. Go.
All right, good. Good to see everybody. So first of all, just a quick introduction. Christopher Stern, certified financial planner with Edward Jones, and I provide people with financial peace of mind. All right. Investing in stocks is the biggest component to generating wealth. Historically, returns are proven to show that the stock market outperforms real estate all the time. Using the Zillow index, ZHVI, Zillow Housing Index, forget what the V stands for. Average returns over a 21-year time period, cumulative returns. Housing prices have increased by 152%, where the S&P has returned 242%, NASDAQ 297%, Dow Jones Industrial Average 237%. Yes, I came dressed for the part. I got my facts and figures. So let's stick it over to you.
Oh my goodness.
Real estate. My average returns are 500% week over week. I don't need to dress in a suit, and we're all good. Omar.
Hey guys, so can I chime in here on something very funny?
I guess so.
Go for it.
All right. So Carl Pearson once said, "Statistics is the grammar of science."
It's up as far as you can go.
And there's a couple other funny quotes on statistics because we all know that things are manipulated and they don't really make sense. And leave it to stock guys to give you statistics. So when we talk about averages, if I take the average of 4 numbers, 1, 2, 3, 4, I get 10, right? What's the average, guys? Right? You just take 4 divided by 10. Now, if I take 1,000 different things and take the average of that, it fluctuates and changes. So you have to ask yourselves, what numbers are being presented to you? The numbers you just got from the Zillow index is the increase in home value, which includes residential value. You have to ask your financial advisor, like, hey, does that include rental incomes? Does that include the actual average rate of return for flippers? Or did you just take the aggregate average of increase in real estate prices over the last 30 years and compare it to stocks, which are compounded and traded? So you have to always compare apples to apples. Don't just look at statistics because they don't make sense if you're not comparing the same things.
Thank you. Omar, what do you think?
I think real estate, hands down, because stocks don't give cash flow, and the ones that do, as far as dividends go, are like 2 to 3%. They won't allow you to retire until you're like 80 years old.
So Nemo, I love your phraseology because you're right. It was residential home values, so it is a gauge, and we're going to get into all the disadvantages and advantages that stocks and real estate prices have versus one another. Okay, so listen. I'm sorry?
I think the listeners would love this. Could you compare to us the direct analogy, because you'd be the best person to do this. Talk dividends versus returns. So dividends on stocks versus returns on rental income.
Yeah.
So Nima just wanted him, just in case you couldn't hear Nima all the way from Miami, thousands of miles away. Nima wants you to compare dividends on stocks versus returns on real estate.
No, perfect segue, and that's what I was just going to respond to Omar's suggestion. First of all, dividends go as high as 10, 11, 12%. Okay, and we're just talking stocks. You throw the bonds in there too. You have coupon payments that are also paying tax-free, whether they're muni bonds or corporate bonds. They could be as high as 5, 6, 7%. So those are coupon payments / dividends. Think of them essentially as your cash flow and your investment if you had a rental property and you had your renters paying. Quite frankly, I don't know what the cash flow or the dividend yield could possibly be on real estate returns. But again, you're not taking into account with those returns, very easy to manage a stock. Throw it into an account, depending upon the account, which I can't wait to get into all the different tax advantages.
I got 50 grand right now on the table for you. I will invest in you immediately. If you got a stock for me that gives me 10 to 11% dividend.
He said he has 50 grand on the table. If you have a stock that's going to give him how much? 10 to 11%?
10 to 12%.
10 to 12%. Ooh, he's taking out his folder.
This should be in your head.
It should. You know, how many stocks are there in the universe? Probably as many rental properties as there are in the house. All right.
10 to 12%.
Dividend yield. I like this.
$50,000.
While Chris is thinking at him.
AT&T, 9.4%.
That's on 10.
Oh, 10?
Not its rate of return annualized.
I understood the question. Dividend yield, we're good.
Guys, he understood the assignment. Isn't that what the young people say?
All right, out of our focus list, right, that 10.9, BHP Group PLC ADR, 50 grand, pay up, where's the check? And we could probably leave and finish this conversation right now. Actually, that I have as well. Would you like the wire instructions now?
So, okay. I'm gonna back this up for our viewers.
Okay.
I'm gonna back this up, and one I have to say, are my stocks in that BH thing?
No, because it's diversification. You have a mutual fund that has exposure to
How long has
that.
that company been in business? Is it
And
gonna
what
be
kind of
tomorrow?
risk is there with that company?
Exactly.
We lost Nima.
Oh well.
He probably
You know what? He's going to wire me the money right
He
now.
wants to
That's
pay.
where he is. He went to the bank.
So.
But from a risk perspective, though, so you know, back to we were talking at the beginning, you know, real estate versus stocks, and you know, obviously, I love real estate, I love residential real estate, I like the investment side of it, but I also have money in both aspects, right? I own my house, I own things like that. But
As you should.
diversification is the word I was going to use.
Yes, thank
so,
you.
You know, I don't think, and you guys might disagree with me a little bit on this, but I always think that, you know, having diversification is always good. Having a little bit of everything. I wouldn't put all my money in the stock market, but I wouldn't put all my money in the housing market either.
I lost everyone there.
So that's kind of my take on it. But so talk about risk with what is it, BHP? So what kind of risk, like, you know, like Eric said, like how long have they been in business?
We're vetting this stock before you put your money in. Go.
All right, so a couple of things, Adam, thank you. Because seriously, I came in hot and heavy right now. I preach diversification. I am a certified financial planner, all right, that employs a comprehensive, holistic wealth management approach. I get the opportunity to speak every 2 weeks to these classes, correct?
So yeah, but this goes out to everyone in the world.
That's.
It depends on what happens today.
Yeah. Well, I'll be invited back. I'm pretty sure of that. But honestly, I advocate both because each one of them have pros and cons. Yes, I'm a stock and bond guy for reasons that we're going to outline today. But I see tremendous value in investing in real estate. And again, so I appreciate you alluding to that. If you want to speak specifically I'm not an analyst. BHP, though, it's on our focus list. Our company, we follow 50 major stocks, and we update those stocks every month. Those stocks are vetted using a stable management product, competitive advantages within the industry that they operate, as well as long-standing increasing dividend payments. Those are just 3 of like the 5 or 7 criteria that the nerds, okay, at home office in Edward Jones use to vet a stock. So as far as the risk, there's risk in any investment you take, whether it be real estate, whether it be crypto, whether it be individual stocks. Putting all your eggs in one basket is a fool's errand. It really is. Everything has pluses or minuses. So you asked, is all of your money in one stock?
No, I didn't say all of my money.
Oh, yeah. So you do have exposure to this through mutual funds because you have to diversify accordingly. You know, we want to talk about inflation right now. Inflation is rearing its ugly head, 7.5% CPI index today. So you want to be in value stocks as opposed to growth stocks, where prior to about 6 months ago, you wanted to be in growth stocks for the last 12 to 15 years.
Okay, my head is exploding.
You asked me down the list, so let's get...
Okay,
you know.
let's talk about real estate a little.
Perfect.
Okay, give me the pros of investing in real estate. My real estate.
So really, let's talk about that stock for one more second. What happens when? Hold on, I'm speaking over in Florida, vacationing. What happens when that board of that stock, when somebody does something bad, and then the stock tanks? What happens when one of the accountants? I guess he didn't like me.
Flip him down.
What happens when one of the accountants does something bad, and then the stock tanks? What happens when the world changes and the stock tanks? With real estate, you can actually touch it, you can feel it, you can rub it, you can fix it, you can control it.
You have control.
You're the boss, you're in charge. You don't have to go through someone like Chris, who happens to be amazing, but he's relying on what other people are telling him. Like he just said, the nerds in back office. What if those nerds are
not that
high that week and they make the wrong decision? Like now it's illegal, or no, it's legal now in New Jersey, so I guess that's okay. But what if something is wrong? I don't like that. I want control. I want to know what I'm touching. I want to be able to manipulate it myself. I don't want the risk that Chris wants you to have.
Now, so there's also, when it comes to real estate, there's also different methods that you can actually pull your investment out, your original investment out. So you can buy something, essentially fix it up, re-rent it, refinance it, and pull your money out. So now that same, let's say $100,000 can be invested over and over and over again. And if done successfully, you have limited risk because now you don't have your own capital invested in this particular property.
So yes and yes. First of all, I don't want any of you to have risk. That's my job, to mitigate risk for all my clients. That's first of all. So I want to correct what you just said. Second, you spoke yourself into a risk. Pulling money out and refinancing. Good luck, because the one thing that you always said, Mr. Anderson, that resonated with me, we were sitting in with the sangria, no chase, okay? And you said, if I have to finance my kids' education or what, I'll just pull money out of my buildings. Good luck doing that in a rising interest rate environment. I could have put your money into a 529, have that money compound at 8% average annually, come out tax-free. You're going to pull money out of your successful buildings, and you're going to be hit with a potential 5, 6, 7% interest rate, depending on where the environment is. And you're in that today. Risk.
Which is tax deductible.
Up to $750K, that's fine, but...
It all depends. The more real estate you own, the more opportunities you have to have tax deductible experiences. You still have control. Does Chris have a point where if your interest rate's higher? Yes,
it's a risk.
But
it's a risk.
It's also a risk that stock could disappear. So even if it's in that plan,
100%,
it could be gone.
What do you mean the stock
could be gone?
Well, they could go out of business.
Yeah. Stock could make more money.
Enron. Okay.
So Chris,
how about Madoff?
GE.
Yeah.
When did you ever see a building disappear?
Unless it burns down.
I mean, the land stays. But.
Yeah.
Go ahead, Omar.
So I think for most people who invest in stocks, the idea is, let's say I'm 25 years old.
Sure.
I have $50,000 I'll saved, and I put into the stock market.
Yeah.
My idea of that is that maybe in 30 years it'll be worth 6 figures, and I just write it out. I don't have any control over it, and I don't receive any income for those 30 years. And it's kind of like a long-term pursuit that I wait and I wait and I wait, but
so yes, if you want, you could take the income.
Guys, for those of you who watch this is on his cell phone. He has a calculator out.
Well, because I want to put numbers to what he's saying. 50K, right?
Yeah.
Okay. Compounded. I'll be conservative. 7% annually over 30 years. It's $380,000. Okay. Now, yes, you could take that 10% dividend in. That erodes your compounding. So that 380 gets decreased significantly. Right. So you would get income if you wanted to. And I'm not disputing the fact that you're right. You put a real estate investment, you have a tenant that's paying off your mortgage and probably earning you some cash flow as well. So I don't disagree at all.
Right.
I think it's just two ways to achieve potential. Now, again, I love the tax benefits of real estate. Love 1031s. Love Section 121. Love makers depreciation, right? 27.5 yearly deduction.
What are all these things?
I'm going to let the real estate guys talk about it.
So what's the 1031, guys?
Eric.
No, weird. The CFP knows what it is. Weird.
All right, so 1031 is when you sell, ideally, an income-producing property that has significant equity in it, and instead of paying capital gains taxes, you buy something else that's in like kind.
Okay.
So you get to exchange a property. So it's literally you're exchanging one piece of real estate for another. It allows you to take advantage of, let's say, a high sales opportunity. It also allows you to take advantage for growth through leveraging. So let's say you have a property that you paid $500 for. It's now worth $1 million. You could sell it for that $1 million. You now can go out and buy 3 properties for the cash that you just got without paying any taxes, all 0 taxes. It's super, super exciting. I've personally done 2 of them. And
as you
it's
should.
amazing.
That's the advantage of real estate. Not denying it.
You can't do that with stocks.
What's your time limit on it?
So, is there some hair? Little hair. It all depends on what you're doing. You have 45 days to identify up to 3 properties, and then you have the balance of 6 months to close on them. However, if you're selling something, remember, whoever owns the property is in charge of the gold. When you're selling something, you can say, hey, Mr. Buyer, I need to make sure that my contract with you allows me to find those 3 properties. So there's ways to mitigate what Chris is alluding to as like huge issues dealing with the 1031 exchange. So
actually, I was actually not alluding to huge issues. I was just saying there's significant advantages to dealing in real estate. So what's Section 121?
No idea.
Okay.
Wait, Omar, do you know?
I don't.
I don't know.
Okay.
Adam, you actually do know. I'm just being technical.
Is that from the penal code?
It's the 250K reduction of capital raise, $500,000
for a single person.
You guys are talking. Tell our audience what you were saying.
So for your primary residence, you buy your house, you own it with your spouse or significant other. You're allowed up to $500,000 in. You don't have to pay taxes on the first $500,000 in capital gains. So if you buy for $500,000, you sell it for $1 million. As long as you live there, I think there's a certain set amount of time you have to live there.
Yes.
As long as you live there, is it 2 years? 3 years. As long as you live there for that certain amount of time, you don't have to pay the capital gains. So now you sell it for $1 million. If you sell it for $1.1 million, you pay taxes on that dollar.
Okay.
As long as you're a married couple. If you're single, it's $250,000 an individual.
Okay.
Does that include domestic partners?
Yes.
There you go.
But so let's talk about 1031 exchanges, right? Because Omar, you brought up a good point on taking your money or cash flow. Yeah. 1031 is great to defer taxes. How is that supporting your retirement? You buy a building for $200K, flip it 10 years later for $1 million. You got a gain of $800K. To avoid the taxes on that $800K, your investment property, you identify a property over 6 months, you throw that $1 million into another value. Where'd your cash flow come from to support your retirement? Fine, monthly income depending on what it was, but same thing with the stock on a dividend. You know, how is that going to support you? Tell me how it's going to support your retirement, either one of you, please.
So as far as 1031 exchange goes, to start with, it's kind of a higher level transaction to begin with. It's not open to everybody. I haven't done a 1031 yet. So
it is open to you.
But it is, you just haven't utilized it.
Right, because to get to that level where it makes sense to do a 1031, it's not an everyday transaction for
it's a way to defer gains. It would be similar to an IRA account or
So if you're in it and you're able to do a 1031, the whole goal would be to buy more property that has existing cash flow.
Okay.
So you trade a small building for a bigger building, but you still maintain that building should still produce cash flow.
So the cash flow then would be your retirement income.
Or multiple buildings, because now you're increasing your cash flow. Okay, and those buildings don't go away. Typically, rents don't go down. Obviously, just like with a stock, you have to know what you're buying. Okay, and you should try to pick and look for areas with growth or look for a more stable scenario. But real estate doesn't disappear, you know, unless you're on the beach and the tsunami comes in and washes it away. A stock could disappear.
So great. Go ahead. So great. You got your retirement income plan, generating cash flow. You're being hit in ordinary income. Say you're just making, for easy math, you're making $5,000 off that building a month. Yeah. You're being taxed at ordinary income, yeah?
But you have depreciation, which helps offset all that.
The cash flow.
Yeah. You're not.
Okay.
You have depreciation, so you don't.
So
get
that
taxed.
offsets the
your
taxes.
income.
Does
Absolutely.
it offset it to a tax-free investment?
It could, depending on how many buildings you have.
All right, how about this? How about you put your money into a Roth account? The gain of $330,000 that I told you,
Yeah.
all invested into a Roth account over time, and you don't pay taxes on that. How does that fund your retirement?
See, I think
darn
it's
good, right?
right, but I think we're talking about two different types of investments.
Yes,
Right?
and there you go. We certainly are. You're right. You're
So
right.
I think the stock option-
Advantages and
Yeah.
disadvantages.
However,
to
the
both
Roth
of them.
account, when you take the money out, the Roth account goes down. And in theory, you could outlive your Roth account. Real estate is there forever. And the buildings just keep on generating money every day, and it goes to the next person, and it goes to the next person. The Roth account eventually will just go away.
It's a cash fund.
No,
Right.
no. I'm sorry. That's totally disagree on that. Let's look. Come on. You're going to tell me no real estate investment in the history of the world, great financial crisis. Look at all the exorbitant high leveraged loans that basically tanked the Midwest, the Southwest, and everything. All those real estate investments, they kept on appreciating. Come
It
on.
depends on the deal. So you have to educate yourself and know what you're buying.
Yeah,
And
yeah.
as Omar said, not everyone's applicable, but they are. But you have to know what makes sense. And as long as you educate yourself there, just like you would educate yourself in the stock market,
There you go.
then you know what to buy.
But so I just want to go back. So real estate, always invest 100% of the time.
Always.
Now, I can send you the Zillow file that I did so we can see the ebb and flow of the real estate
You can
investments.
get down and dirty. You can take your jacket off.
Well, we could. I should have took it off. I'm not sweating yet. But that's just erroneous. It's erroneous. It's a false statement. That's like me saying the stock market has never went down. It has, but over time, it's been a positive line. I'll defer to you to agree with that. Real estate ebbs and flows like any other
So
investment.
it does, but let's assume that you have a cash flow producing property.
Okay.
The market can go up, it can go down. Your property's still producing cash as long as your tenants are paying.
So you could have a dividend paying. Here, muni bonds. Muni bonds.
But they pay like 2%, don't they?
So
Good.
So you're throwing out all of these terms
Okay.
that our audience may not know.
Oh, muni bonds? I was going to.
Okay, you're
just
going to
of
do muni
course.
bonds? Okay, go
I
muni
teach every
bonds.
2 weeks to this
Okay,
class.
go muni
Don't I
bonds.
explain things good?
You do.
Municipal bonds are essentially a debt obligation to a municipality or a government. Okay? Essentially, you're giving them money to finance a project, Hackensack to build Lower Hackensack over here. It's an IOU for a certain period of time. While they hold your money to finance that project, they send you what's called a coupon payment. All right? Yes, currently they've been as low as 2, 3, maybe 4%. But if you go back to when interest rates are high, and they're going to start going high, they could be as high as 7, 8, 9%. And P.S. that's tax-free.
What's a coupon payment? That seems a little cheesy, like I'm getting one of those
Municipality
value
can-
packs.
It is. Guys,
What's a
stock-
coupon payment?
Can a municipality go bankrupt?
Huh?
Yeah.
Okay.
Yeah.
Detroit was bankrupt not too long
There you
ago.
go.
That's
That was a
yeah,
rhetorical
that's-
question, but
Yeah, absolutely. That's why
So
bonds
what
are
happens to
rated.
that bond?
Well, you do your research, just like
Okay,
you said, with the
okay.
markets that you're going to invest in.
Have you ever seen a piece of land
And you
that's
do-
in there? Very rarely.
But the value of that land has went up and went down.
Yeah.
It
If
is.
you
So,
have the
Omar,
cash flow,
to continue addressing your question, municipal bonds coupon, it goes back to like the 1900s when you clip a coupon because everything was sent in the mail.
Mm-hmm.
And like your statement was clipped, and you clipped that check, and you went to the bank and cashed the check.
Okay,
Clipping
so it's an
it, right?
IOU.
Yeah, essentially, it's a dividend payment that they're sending, but all that is tax-free, and it could be triple tax-free. Free from municipality, free from state, free from federal. So even though you're meager to 4%, if you do the after-tax math on that, that's upwards, just do the inverse of whatever tax bracket you're in. So
Right.
that's paying you money, that's paying you coupons as well. If you're Ross Perot was worth how many billions of dollars? He never paid taxes. Why? Because his billions of dollars were in all muni bonds, generating him tax-free income.
But couldn't all of your millions of dollars be in real estate and you still not pay any taxes?
I'm not as...
And don't
I'm
you
not
have to be a
gonna-
certain age to get access to that
That's
tax-free
right,
income?
access. Let's talk about access. That's
Sure.
a very good
So
point.
Ross Perot, how old is he? Like 89 now? So
Now
of course
he's
he has
is he
access.
alive?
But when he was 40, did he have access to that tax-free income?
How old do you have to be to get access?
You're wrong.
I'm asking. Tell
A
me.
muni bond is an investment. As long as you're the age of majority, 18 years old, you're...
Tax-free.
you're thinking of the retirement accounts, Roth 59.5. That's not in an account. Muni bond, you don't put in a tax deferred account. Why? Because there's tax savings inherently built into a muni bond. So well, as long as you're age of majority, 18 years old, 21 years old, depending on whatever state you're in, you could have a muni bond portfolio. What you were referring to is accounts, and we could get into that later, but as far as access.
Well, no, but okay, most people think of, when we're thinking of saving for retirement, right? We're thinking of these retirement accounts, right? And when can you access those retirement accounts without being hit with amazing penalties and taxes and
the rule that everybody knows is 59.5, and we're thinking tax deferred accounts, think your 401ks, 403bs, 457s, or 55 if you leave work and separate from service, you can do what's called an in-service withdrawal. However, I'm a certified financial planner, so when you want to retire early, come see me. We'll talk about your real estate portfolio as well as your investment portfolio, and we'll discuss 72T. 72T is equal periodic substantial payments over time where you could retire earlier than 59.5 and not pay any taxes on it. You're essentially annuitizing your retirement account. So yes, the rule that everybody knows is 59.5, but there are ways around it.
Okay, so you do not necessarily have to be 59, but you have to plan for that.
You do. Thank you. Just like you have to plan for real estate.
But your income could still drop because as you're withdrawing that money, your pool
income is going down, right?
Not with the rate. No, not with the rate of return. Not with the rate of.
Well, the rate of return changes with rental income.
Not on average.
When have you ever seen an apartment go down?
Rents do not go down.
March 2020, when everybody fled the city to come suburban, did rental rates drop significantly, just like the market did at 40% for a period of time? Yes or no?
But that is such a. How many pandemics are we going to have?
Areas.
How many pandemics are we going to have in a lifetime?
Hopefully
2.
Right.
1, and this was it. Hopefully 1, this was it. But guys,
we weren't
alive.
Yeah.
Hopefully 1 in our lifetime, and hopefully we're done. But we're saying.
There you go. So real estate. There you go.
We're saying the same thing. No, you're just trying to say that real estate has no risk to it. It does, and I'm not saying stocks are the end all be all. I am not. But let's look at where the pros are in stocks. There's cons in real estate. And definitely vice versa.
So which one, on a short-term basis, which one's better, you think, when it comes to a high inflation environment like we're in right now? Like 7.5% was just announced this morning.
I know.
So where does that leave, if you have a $50,000 and you're going to put it into the stock market for the next 2 years, what does inflation do to the stock market? In general, I'm not going to.
Yeah, no. It's volatile.
That's a loaded question.
No, it's volatile. You're 100% right. You're 100% right.
Because Zillow just
you're right.
Zillow, you mentioned Zillow before, and I won't say I'm diversification on that, but Zillow just announced within the last week or so that they anticipate housing prices to go up 16% this year.
Well, they went up 18% last year. Yeah, you're 100%.
So 16% this year. Now I know that's not.
I don't think the market's going to do that this year.
Didn't the market go down?
So you're right. We're looking sub double-digit returns, but again, and you know me well. If you're looking for your money in 2 years, probably ain't putting your money in the stock market. I'm not, depending on what the goal is. And now that's the CFP coming involved.
April, April wants to know what are the tax advantages of real estate versus the tax advantages of stocks?
Should the CFP answer this? Because you got 10.
I'm not a CFP, but so, I can tell you that when you're ready to get your real estate license next month, we can certainly help you with that. But anyway, tell us.
Real estate
what are the different tax advantages?
April, we kind of quite fastly went over this a little bit before in our friendly debate, but real estate has 1031 exchanges, which I think Eric defined perfectly for. Depreciation expenses, which is huge. That's the maker's term that I alluded to. And then we have the Section 121 for primary residences.
So what does the depreciation makers mean?
It means you can basically increase your cost basis by as much as maintenance.
So I don't have the exact numbers because I have a really good accountant, and what I would advise to everyone is just like you have a really good financial planner, because real estate is not for everyone. Some people just can't handle the logistics of it, and for those people, then yes, stocks are better. But for the rest of us, I just get a great accountant, and so if you have a building that's worth $1 million, you can appreciate that. I think it's like 27 years or 29 years.
27.5.
27.5 years. And what that does is you're taking a percentage of that, and that's like an expense off of whatever your income is. So it just literally cuts income off cuts taxable income off you. So that's why you have people like our famous Donald Trump or other people who have all these big properties, all that depreciation. Plus, if they're fixing these properties, they get the losses from it not being rented or things that they have to repair. All of those things come in and they offset that $10 million that person may have made. And that's how they get out with a zero tax. So totally legal.
So that's how Warren Buffett pays less taxes than his secretary.
Warren Buffett's a big stock and bond guy, but he's got real estate too. Let's be serious.
Someone in real estate would pay less taxes than someone who doesn't.
100%.
Okay.
So I think that's the big three, right, for real estate guys? I think, right? So for stocks, I mean, there's a couple of things. How do I make this easy? So we have tax deferred accounts, April. If you invest, and that's what Eric, I think, was alluding to with the muni bonds about the certain age when to touch it, there's accounts that you can set up. Think your workplace retirement plan, 401k, 403bs, or the traditional IRA. Both are the same, different IRS codes for the same type of account. These are called tax deferred accounts. What that means is they help present April while helping future April. If you contribute to these accounts, whether it's $6,000 or $20,000, $500, it reduces your present taxable income, so you pay less in taxes now while that money grows tax deferred. Yes, you're going to pay taxes on it, ordinary income. When you pull it out, the idea is when you're retiring, you're not in as high as a tax bracket as you were. That's one advantage. Then we got the almighty Roth. We love a Roth account. Roth account does not help present April. You fund that money with after-tax money, but like the example I used with Omar, all the growth in that account, $50,000 over 30 years to $380,000, that growth of $330,000 comes out tax-free. You don't pay a dime on it. Then you have taxable accounts, okay, where you're taxed at qualified capital gains and or losses. So for every buy and sell you do, if you sell at a gain, no, there's no 1031 exchange here. If you want to realize your gain, you're going to pay reduced rates on it, anywhere from 0%, 15% to 20%. You can also take the losses similar to depreciation. Nobody really wants to sell their stock for a loss, right? But it can deduct against your ordinary income and carry forward as well. Then there's the muni bonds that I mentioned, which is tax-free.
Do you ever think that they're going to start taxing unrealized gains? Because they always talk about that. Which would kill the advantage of having...
Oh, yeah, then all my strategies, this may be a very different conversation next year, but they're looking at going after the Roth as well. But we're not going to surmise in that. I think there's too many, and there's too many rich people out there, I think, that utilize the Roth accounts. They're not, and they're all in Washington.
So what I'm hearing, and I just want to bring it down. What I'm hearing is that real estate is a lot more simple when it comes to actualizing your tax gains, where all of these accounts, you really have to strategize and you really have to
diversification. Figure it out. Yeah, real estate, you don't need any type of accounts. You just need a good CPA, which is one thing Eric and I agree on. You need multiple accounts to help mitigate your tax strategy in the future.
So we have David. And David wants to know about investing real estate in IRAs.
Yeah, that's...
How do you do that? What is it?
Like a REIT.
David, like a REIT or buying a house in a self-directed IRA?
Just go through
I think he means a REIT.
Yeah, okay. Then self-directed IRA is a great...
what's a self-directed IRA?
Because you could use that money towards real estate. So maybe
So let's go with that.
I'll go with both. David, you want to buy a REIT? That's an investment, by the way, and it's sold on the stock market and exchange. It just happens to be an investment in real estate investment trust. So you could, if you don't have the capital, the leverage, you could buy a REIT. And they have pretty good returns and very good dividends. You put them in an IRA, you enjoy all the tax advantages of it. There's no capital gains and or losses when you buy and sell, and all your money is tax deferred. But there are age restrictions on when you can pull that money out. 59 and a half or the 72 take. A self-directed IRA, it's extremely complicated, but to really simplify it, a self-directed IRA means you have control over your IRA, so you're not associated with a brokerage or an investment firm. You need a custodian, right? Because This is no longer your money. A custodian is kind of in charge, making sure you abide by.
So is a custodian someone like you?
Edward Jones.
Okay.
Edward Jones. Yeah.
Okay.
Correct.
Okay.
Correct. But essentially, what you do, self-directed, you can buy alternative investments. Think investments other than stocks, bonds, mutual funds, ETFs. Think real estate. You could buy a house, a physical house, a building in an IRA. But here's the catch. There's no leverage in a self-directed IRA. So if you want to buy one of his buildings, what are your buildings going for right now?
$10 million.
Yeah. For $10 million, you better have $10 million in your IRA. Actually, you better have 20 million, because when the market ebbs and flows and costs increase and vacancies hit your cash producing properties, that's another way, by the way, your cash flow goes down. You're going to need money within that self-directed IRA to cover those costs. So, and it's...
Or you just make sure that you don't spend all that money that you're getting, so then you build in a vacancy factor.
But to that point, in a self-directed IRA, you have to buy the property outright in full cash. So if you're...
But you can invest in something. So you don't have to buy the whole property by yourself.
Yeah.
Right? So, like, Omar, I know you've worked with some of this stuff.
Oh, like 50-50, use $5 million.
So I've had investors who have 401k money after they leave their employment.
Yeah.
They could put that 401k money into a self-directed IRA.
They can.
And then lend someone like me money, which I give them a profit share in return through that self-directed IRA.
How do they lend you the money?
Just a promissory note. So just like you mentioned.
Oh, like that's the collateral.
Yeah. So just as you mentioned, the custodian account holds the self-directed IRA.
There you go.
I have an agreement with the custodian account where they'll lend me $100,000 at 10% a year.
Perfect.
And that's just a promissory note. But whatever money they make goes back into their self-directed IRA account. They can't cash it out. So
So that is for the retirement.
Yeah, that's for their, good.
Yeah.
And thank you.
Just another option.
So, okay, this has been a little bit more contentious than usual. I love it. I love it. I love how you guys are giving everyone what you need on all sides of the coin. Real estate. What do you need to do to invest in real estate for your retirement specifically? What should people be looking at? What should they be doing?
You don't need to do anything different.
But
it's just
what should they
investing
be
whether
doing?
you're old or young. It's just getting the right properties that
But are you investing like as a partner, like with him, or are you doing leveraging?
I believe more in being more in control of it. I don't really like the REIT concept because it's just, again, even though it doesn't give you the same type of control, it limits it, but a REIT could go out of business just like a stock could. It's all the same. You still have to worry about all the people involved and all the things. If you do it more isolated, where it's you or you and a partner, or something more localized, you still have the ability to touch, to fix, to tweak, to do whatever you need to do. You don't have that with the stocks.
Yeah, I think in terms of comparing the two, I'm all for stocks as well, just to make that clear. I'm not just real estate. But the difference that we're not discussing...
So maybe I'm not outnumbered here today. I appreciate that. Thank you.
Let me explain what I mean. Let me explain what I mean, though. The investments in stock, you park your money and it grows. In real estate, it's active investing. So
and growing.
And growing. So you have to find the rental property. You have to know your numbers. You have to actively be involved in it. Stocks, you can hand it to someone like Chris and sit back and let it grow. But they're two very different investors.
Or let it go.
For two very different investors.
Yes, two very different investors. So people who have a full-time job and don't have time to go out and find rentals and deal with tenants, yeah, the stock market is great. But in my opinion, if you had to choose one between the two in order to build wealth, hands down real estate.
So you know that song from Frieson, Let It Go, Let It Go? That's
what the three of you are all humming to yourself. Let it go.
Okay.
Adam, where are you on this?
I'm still, I'm still kind of.
He's still on section 121 right now.
I'm still, on both sides of things, right? You don't want well, I think you said it, Chris. Don't put all your eggs in one basket, right? That's the main thing with any type of investment. So don't put all your money into real estate. Don't put all your money into stocks. Don't put all your money into one stock. Put it into, diversification of stocks. Put it into mutual funds. Put it into bonds, whatever it might be.
Residential real estate, commercial real estate.
Exactly. Don't put all your money into just residential. Get residential. Get a mixed use. Get commercial. Get, a little bit of everything. I think that's the best way to really save long term, because if you put all your money into one thing and something happens to that one thing, you put it all into one stock, or you put it all into just the stock market, the stock market tanks, you're out. But the same thing could happen with the housing market. Over time, yes, they both generally go up, but you never know what could happen tomorrow.
That's why you base your rental, your real estate investments on your cash flows.
Yes.
The cash flows stay stable. Okay,
And
with the stocks going like this, and the dividends going like this, and all that stuff going like this.
But you account for vacancies, capitalization rates, and all that, and that's how you determine, and that's how you value.
Yes, but then you come up with this is my stable realm, and it stays.
It averages out to positive cash flow. But the concern that I would have with stocks, being too heavy in stocks, is if I'm in my retirement year and the economy is in a recession, my stocks just took a 40-50% hit.
Which is why you change your portfolio allocation as you get closer to your time horizon to protect what you work so hard.
Explain what the time horizon is. I remember us talking about this. Yes, I remember us talking about this. What's
time horizon. What 3 things you need to know before you invest in anything, whether it be real estate, stocks, bonds, anything. First, what's your goal for this amount of money? What's the time horizon associated with that goal? Are you saving for a house, down payment, a year from now? Or are you saving for retirement 5 years from now, or maybe more like 25, 30 years from now, right? I'm glad you picked up on that. So, and then first, what you're comfortable.
You are older.
Yeah. Listen.
Anyway.
So those 3 things help determine a portfolio objective. Time horizon is how long. The start of my goal for retirement is probably like 65, 70. I don't, when I'm going to need to pull on that money.
Well, 5 years.
That's 30 years from now, officially. That's 30 years from now. So that's the time horizon. I can afford to be very aggressive because the average time cycle of the stock market is 10 years. That means over time, 10 years, you do get a positive return. What happens in those 10 years could be like a roller coaster, Space Mountain, but different from...
What happens if when I turn 65 and then the stock market tanks right at that moment, and then I can't do anything?
Because by the time you turn 65, right now, you're in, Omar, you said it, heavily allocated in stocks and only a little in bonds. Bonds tend to be very conservative. They're the buffer. By the time we get you to 65, we're going to start switching that allocation. You're going to have less exposure to stocks, not as much as 80%, maybe think 60-40, 50-50, which is why you always maintain some sort of exposure to stocks, so this way you don't run the risk of depleting your money.
So as we get older,
but when the stocks go down and that return goes down, then you are depleting your money. So if you live to like 120, you're going to have nothing left. And what are you going to give to your kids?
I'm sorry, when you live to how old?
120.
Okay.
He's going to say the average lifespan.
No, we run the scenarios through 95. I'm glad through 95. We like to, the system runs it through 90.
I actually read an article not too long ago that says that scientists determined that the longest a person would be able to live, like just your body, if it was kept in perfect shape, would be 150. But that's if something like medical-wise went great. But that would be the longest that a body, like the components of your body, could actually
But that's why
last.
they're genetically building new pieces, so you can get...
Well, you'd have to have a whole, like everything would have to be new.
Well, there's that bulletproof guy that has that diet out. He's claiming that he's trying to live to 150. So.
Right, I think it had to do with that, but just...
So you should talk to him to make sure he has the right
Just the 120. Okay. Can we talk about inflation? Because I know that's been on the news a lot. I know that they said that steak just went up $2 a pound. I saw that on morning news. That cars, most people are paying like 10% over. Yeah, 10% over on a brand new car. So inflation is going wild. What does that have to do with our retirement? What does that have to do with our real estate? What is inflation doing to us?
I mean, listen, everybody's very spoiled. The last 20 plus years, we've been in no inflationary environment. Historically, on average, inflation, the price of goods, rises by 3% every year. And yes, I use averages because that's what life is. Life is averages, whether it's real estate or stock investing. So every 3 years, that means the cost of goods is going to double every 21.5 years, right? Right now, we're up and against the pandemic, supply chain constraints, emerging from this pandemic. Price of goods is higher. It's not going to sustain at the 7%. But
you think it's going to go down?
Eventually. I'm not going to get into the macroeconomics. It's not going to stay. We're not going to go back. this is before all of us, at least on this panel, 1970s inflationary, 10%, 12%, all those high things, high interest rate environments. But that's why you invest in anything, stocks or real estate, something that's, you can't sit in cash, I guess is where I'm going. So it's a risk, but this is why you invest. And this is why you don't hoard cash, because cash doesn't grow. Investments grow.
So no matter what, if you are in inflation, you're saying that you must invest, whether it's in stocks or real estate.
Yes.
You should invest.
But even more so.
Nobody must do anything.
Should, yes. Nima's not here for a disclaimer. Yes. You should invest.
Insert disclaimer here.
Right. We'll put it across the bottom. You should invest, especially when you're in a high inflation time.
You should invest in real estate. Absolutely. Well said.
But historically, though, going back to that, what I was asking earlier, historically, how does the stock market historically perform in a high inflation environment? Take it back to the 70s or something like that, where we had 10, 12%. I know, like you said, we were always at 2, 3% in my lifetime. Yeah. But now we're at 7.5%, and it could go even higher. It just went up. I mean, it was, what, 7% they were estimating, now it's 7.5%.
Yeah.
So what do you see as the stock market? What do you see in terms of those types of investments?
Historically, inflation is not a threat to the overall stock market. Returns are going to be muted this year for sure. There's no doubt about it. But again, we've been spoiled with above average returns too, double digits, 20 plus, 25, right? We're looking more sub, maybe 8, 9, 10%. Earnings, it's earnings. It's all about earnings. And as long as the Fed doesn't move too quickly and really spook the market, a lot of these inflationary pressures, the rising of the 10-year, the Fed increasing interest rates, they're already baked into the price.
Yeah, but let's talk about that. They've already announced that they're going to be increasing the rate, whatever, half a dozen times throughout the next, the rest of the year, something along those lines. Is it only 4? Okay. I heard 6 times.
That's still a lot, isn't it?
That's still a lot.
Yeah, but guys, a lot from zero is, think about it, we're at 0 and they're only doing quarter
point. It's still low, but I'm just
so we're at 1%, right?
What does that do though to, I mean, I know a lot of tech stocks, when the interest rates go up, tech stocks tend to go down, the NASDAQ, right?
Correct. So a diversified bucket, proper portfolio, you want to be more exposed to value stocks, stocks that pay those dividends, that aren't in the growth sector like technology. That's why technology is getting hammered. But, just like everything else, when things get hammered, it's an opportunity. Do we really think Amazon, Alphabet is going to go out of business? No, right? But guess what? I bought it at a discount for 15% off 2 weeks ago. So it's just having that proper diversification.
You couldn't have bought real estate at a discount 2 weeks ago.
No, you could not have. So on that note, we are going to get ready to wrap this up. I want to hear everyone's final thoughts on this topic.
Let me go first.
Yeah, I was going to say the best for last, but go ahead.
No. Which is why I'm going to go last.
I'm going to let Chris go last, but before we do that, okay. I happen to know Chris. He's a great guy. He knows his stuff more than I do when it comes to stocks, because I have no concept about stocks. I think it's way too complicated for me, way too risky for me. Although my grandfather, that's all he did was invest in stocks, and he made millions and millions of dollars. I, so far, at the age of 49, have surpassed what he made through real estate, but it's all good. But I think Chris is great, but I think real estate is the way to go. So, all right, who wants to go next? Omar.
I think they're 2 different investments for 2 different goals, but overall, if I had to choose, I would stick with real estate. To build wealth for financial freedom and to retire younger, hopefully in my 40s, instead of 60-something.
And I'm still, I still think both are good aspects, but, you're right. I think, Omar, you mentioned it earlier. You work at a full-time job. You don't have time to sit there and, look for investments. You don't have time to worry about renters and worry about a boiler going out or something like that. Then a lot of times it's better to hand it to somebody that's just going to do all the work for you. And they're going to handle your portfolio and do everything. But I still think having a mix of both, like anything, having a mix of both is the best way to go, because then you're betting against both aspects of it, and you have, you're going to have good and bad years for both.
Yeah, I mean, I think it all depends to the amount of capital that you have to get started with. My conviction, because I know it, because I live in it and I work in it, it's stocks and bonds, but I can't wait to start building my real estate portfolify as well.
We can help.
But I do have to source the experts, find trusted advisors, do your research, and diversify. Stocks, bonds, value, growth, muni bonds, corporate bonds, residential, commercial, real estate, diversify. Both will help you achieve your wealth and accomplish your goals. Invest. Don't sit on cash.
Real estate, real estate, real estate.
So, thank you guys for being with us. First, I want to remind you to subscribe, so you can get an alert.
Do we have a
hit
button?
that button. Bloop, bloop, bloop. And also give us comments, please. Let us know what you think. Let us know what you want to hear about. What did you think about Chris? And what did you think about stocks versus real estate? Which one are you going to do? So next week we will be back and we're going to be talking about inflation and the rising interest rates on real estate.
Which is the best thing to own. And don't forget, if you visualize it, you can own it.
If you visualize, you can own it. Yay.
Love that.
Good job, guys. Thanks. Bye.
Bye.